wind damage is one that I see that's especially like with folks in Florida. It's a separate policy.
Expensive.
And you have to have a wind mitigation certificate if you live on the coast. You got to pay thousands of dollars to get this updated every year to basically come in and prove that your house can withstand hurricane force winds. So fascinating.
If you get the certificate, why buy the policy?
Yeah, right. That's your insurance, right?
I had a client ask me that question. So
Yeah.
because it's so expensive. So.
Yeah.
That's why I'm going to stand up.
And if you've seen one of those forms, if you've seen one of those forms, it's detailed drawings. You know, it's architectural drawings of the foundation and how the roof is anchored, and you know, it's a very specific description of the windows down to the millimeter thickness of the glass and all this stuff. It's amazing. That's why it's so expensive.
And if you have somebody that feels that they shouldn't have the coverage, you know, then you sometimes have to, you know, go to the level of paying off their mortgage, because any mortgage clause would have
A
requirement for that.
Yeah.
So, and those from a stamp tax perspective down in Florida are expensive to get back. So, just make sure you really think through that process of whether you need it or not, and they'll want verification that you have that coverage if you're not escrowing with them, or they'll place their own coverage on there. So
That's even
more expensive. And if you have somebody that's not very good at reading their mail or relaying their mail, they may have some crazy expensive coverage on something that they didn't want coverage on, you know, for various reasons. So premiums and evaluating a payback analysis, you know, kind of really stress testing. Chris talked about this earlier, just stress testing that, you know, a lot of our clients that are at a pretty high net worth, if the math dictates that it's, you know, it merits it, don't need $500, $1,000 deductible. They can self-insure that risk to a certain amount. Now run it, because it can be drastically different at different companies or different situations, but you know, the likelihood that they can bear more of that risk themselves, and most won't turn in small claims, because a lot of small claims in succession is usually a recipe for, you know, getting kicked out the door and having to deal with, you know, that on your, you know, particular insurance record. So really stress test that. I'm more apt to move up auto or move up homeowners than I am auto.
Yeah.
Because I think auto
having that under control in the
auto, and the pricing risk reward of moving that usually isn't a big gap. Homeowners can be a drastic gap especially if you're moving up to some of the higher levels. You know, who's got a $3 million house? You know, the loss is going to be big, right? I mean,
well, in some of that stuff you can eyeball. Like Mark Hinch wanted to raise his deductible to $10,000 from $2,500. I said, wait a minute, Mark, your house is surrounded by trees. And so I appreciate the fact that, you know, you want to save some money, but the payback on that doesn't make sense. One of these limbs falls down on the roof and causes damage. We're gonna blow right through that really quick. So I think don't go too far. Don't stretch the boundaries of the payback, or else you'll end up being what's the saying, penny wise and pound foolish.
So how do you implement this coverage and then
Everybody know how to do the payback analysis? I think it's pretty common sense, right? It's asking the agent for if I go from $500 to $1,000 deductible, right? So I just increased my premium my deductible by $500, but what's my premium savings per month? You divide that into it, and that's the number of months you have to go without filing a claim before